So Dow Megaphone pattern, the warning has sounded, folks. Attention all traders and beware of the Dow Megaphone pattern. Just a month ago, as I called a bottom in a forthcoming market correction, as of November 1st, the tides are changing and I can hear the Megaphone pattern being turned on. The Dow is now 27,300, but beware. S&P 500 is 3,066, Dow is 27,347, and the NASDAQ is 8,386. You better watch out. You better not cry. Pro Trader Mike's going to tell you why. The Dow is about to take a crashing, you know? It's the Megaphone pattern. Take a look at this chart and compare it to the 2015 chart. Almost exactly the same big gap to fill to the downside at 26.6. So it's even higher. So you have A right here. This is the run up in the Dow. A. And it came down and tested a B. And it went up, actually made like another top right there at the C. It came down a little bit of a lower ascending one for a D. And now it's actually up here for an E. And you've got this whole way coming down. That is similar to the Dow Megaphone pattern of 1995 to 2020 right here. In 2000 and this is, you could see right here, this is the Megaphone. You could see, it looks like a megaphone, right? And from here, it's supposed to take a big, big dumping. Let me show you what the Dow Megaphone is. Dow Megaphone. The Megaphone pattern in the stock market sounds scary, and this is as of September 3rd of 2019. Opinion. A Megaphone pattern in the stock market sounds scary, but there's no need for dread. A so-called Megaphone pattern in the US stock market is gaining publicity, often scary conclusions, but you should trim your based on this pattern. Let's examine with the help of a chart. There's no chart. But that's recent. Here's another one. Recent. September of 2019, September 4th. The September effect. They're talking about it in 2018. Let me talk about the latest, the Dow Megaphone pattern. Right here on September 3rd. That's that article. September 4th, September 2nd, August 12th. Simple pattern projected to the US market sell-off. Some argue it's a news-driven market, blah, 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 blah. Here it is. So here's the Dow. You could see the Megaphone. We've got A, B, C, D, and then the big drop. So actually A is, I thought A was here, and then B. So it's similar to that, but you got this cone. The most basic message for anyone aware of this pattern was not to buy the S&P as it approached the purple trend line resistance. And that's up there at D, which is up here. That's where we're at right now, right there. Big drops. We got a lot of top happening right here. Summary. The S&P 500 emphatically validated purple line resistance. Obviously, a lot of things have to go right or wrong for the S&P 500 to fall to a 2,300. It's over 3,000 now, but the risk should not be ignored, especially while the S&P stays below 2910 and 2990. The low high is 3,000. It's at 3,068 now. Even more of a reason for a sell-off. And that's the Dow Megaphone pattern. Let's talk about Michael Berry, my silent mentor. Michael Berry right now, 2 weeks ago, he's investing in the market crash. He's the guy that is in the movie The Big Short that bet for the housing bubble and was correct. Michael Berry right here. The flow of money into ETFs is going to crush the liquidity of the market right here. See what it says right here? For the last decade, analysts have warned we're on the brink of another crash. So far, they've been wrong every time. The latest doomsayer merits a hearing now, because he's Wall Street's guru, Michael Berry, who made a winning $1 billion bet accurately by predicting the 2008 market collapse. You may not recognize by the name, but the movie The Big Short. I wrote an article on him when he was the hedge fund manager making those bets back in the day in 2008 and calling for the market to make a correction, and it did. He was my silent mentor. Google and Amazon and these Facebook stocks were up at astronomical highs and needed to correct, and they sure did. His latest warning focuses on something millions of ordinary investors now have in their portfolios, which are ETFs. These are low-cost, passive investment funds that dispense with active managers and simply track their chosen stock market indexes, plus a heap of smaller exchanges. Mr. Berry isn't the first to warn against the dangers of passive investing, and he won't be the last. The first ETF launched back in '93. ETFs are cheap and means investors can get more for their money. While an active fund manager may charge 5 cents up front, another may charge 1.5 for it. ETFs have zero charges and annual fees. If an investor puts $100,000 into 2 funds with these charging profiles, both grew an average of 7%, the costly active fund would give them $473,000 after 30 years, while the cheaper ETF would deliver a whopping $746,000. The only difference is the fees and charges. And he says because of the influx of money into these ETFs, it's going to be the demise of the market. Although a small proportion of active funds have beat the market, he says the message has sunk in at the end of the line. The sums invested in ETFs top $4 trillion for the first time, according to Michael Berry. He fears the flood of money looks remarkably like the bubble in collateralized debt obligations, recently telling Bloomberg that the flows will reverse at some point, and when they do, it will be ugly. Like most bubbles, the longer it goes, the worse the crash will be. He's so spot on. So the amount, let's say you want to get into the market as a long purchaser, the reward is small versus the risk is so high. It has to be the other way around. Otherwise, you want to take situations that will profit from the market going down. And that's what we'll talk about as well. So he really thinks because of the outflux of money going to come out of the market with the ETFs, and there's no liquidity, these things are just going to really crash because they all have individual stocks that outlay the ETFs. ETFs have thrived in a period when central bankers have pumped up the stock markets with monetary easing. When the bull market runs out of steam, the downside mitigation, which only active managers can give, may be an increasingly important consideration. He advises against putting all your money into the indexes such as the S&P 500, something too many ETF investors do. There you go. That's a lot about the Dow Megaphone pattern. So what's the play? I think long UVXY right here. And if the stock market volatility comes back in, the stock could fly. It used to be $39. Let's take a look at the strategy for this UVXY. Check it out. It's optionable. So there's a 3 strategy you can do. That's what Warren Buffett does. That's all Warren Buffett does is sell puts. Look, I've spoken about this so many times, folks. This is how he takes control of companies like Coca-Cola. His approach. Based on the analysis, he determined Coke was determined 35 was a fair price for the shares. As a result, he roughly sold 5 million put options at the 35 strike price. Because if it went down there, he was going to own 5 million shares at 35. If the beverage behemoth fell to 35, the option buyer, otherwise known as the counterparty, would put their shares to him, and he would own 5 million shares of Coca-Cola. But that only represented 6% of the company. Then he would go in and buy another 5 million shares, another 6%. He'd own 12. And then he'd go in and buy, 12%, another, he'd own 51% of the company and take it over, kick out the board of directors and take Coca-Cola to the moon. That's what he did. Naked stock options. Years ago, Coca-Cola was trading around $39. Right here, how it works. Suppose you want to buy a put option on XYZ stock selling for 20, which is UVXY at 18. Suppose the trader wants to pay you $150 to let him sell you 200 shares at 18 per share at any time in the next 2 months. Read about this, folks. I'm not going to read you this whole article because I already know what it is. But this is how Buffett made his millions and bajillions. Right here. Berkshire Hathaway collected $7.6 billion in premiums from 94 individual contracts off 94 derivatives or stocks. He's worth $65 billion. Warren's approach right here. I view derivatives as time bombs. Read all this is all about it, folks, and I'm going to explain it to you on UVXY in layman's terms. That the layman, me and you, the average person, can understand. And it's all about collecting rent. Yeah, nice, BJ. So I'll show you right here on a UVXY. What the deal is. And it's perfect because it's down and you want to get it down here. Options. So you want to go into the puts. So you scroll down and they're right here. So the stock is at 18. It's at 18.20. Get out of whiteboard. So the first thing I'm going to do is I'm going to collect the premium. The stock is UVXY. And if the market goes down, this stock will go higher. So the reward is greater than the risk. It's in favor right there. Okay? That's what we got going on. UVXY. Risk versus the reward. It's in favor right now. So the stock is 18.20. It's actually at an all-time low. So we're looking at the first thing we're going to do is we're going to sell the put. And we're going to sell an $18 strike price, SP. It's at 18.20. So the 18 strike price, if we scroll down to the put, is 56 cents is the last price. Let's just, actually the ask is 59. Let's just round it to 50 cents, just for math purposes, even though it's a little bit more. So for math purposes, it's 50 cents, at 50 cents. Or $50 per contract. Okay? This is giving us the right. And the date is, I'm sorry, it's November 8th. We want to go out further. This is only a week. We want to go out a month. So let's go to December 6th. You'll see how much more the premium is. Each month, let me show you how much the premium goes up. It was 56 cents for the 8th. The 15th a week will be more. Look, because it's a 1 week. This is 92. We're going to go more. This is great, guys. You're going to love this. This is great. Then we go out a week more. 92 on the November 22nd goes to $1.26. Beautiful. I think I'll go to $1.26. That's in 19 days from now. That's a 10%er. November 29th. Let's see what that one is. This is unbelievable. An 18 is $1.52. On an $18 stock, you're getting $1.50. Holy mama. I'm going to go out one more week. December 6th. It's going to be over $2. The 18 is $1.63. I think just for a dime, I'm going to go to the other one because the dime, this is $1.63. The November 29th was $1.52. That's only 11 cents. Let's see what I'm giving up for the one before that, $1.52. And this one is $1.26, so it's about 26. I like this one the best because it's the least amount of time with the highest premium. That means people are really bidding up that premium. You know what I'm saying? Absolutely. So I love that $1.26. And the date is right here. We'll click on it. This is the put, $1.26. It's up 7. Doesn't matter what it's up. It's up because people are bidding on it, baby. So let's go into right here. So it's at $1.26. Oh my gosh. So just for math purposes, we'll go at $1.25. That's $125 per contract. That's pretty sweet. Okay, that's pretty sweet. So that's $125 per contract. You're seeing it right there on the UVXY November 2019 put. So that's the 11. When was it? The 6th? 11/6. It expires on Friday. Dude, that's sweet. That's sweet. $1.25 divided by 18 is a 6.6. That's it. $1.25 divided by 18 is 6.9%. That's it, isn't it 10%? No, that would be $1.80. Wow, that's sweet though. Check it out. So here's what's going to happen. On 11/6, see now if I sold, let's say, one contract. I'm going to sell one contract for $1.25, and I'm going to bring in $125. So that's sitting in the account. That's just like that big blue number, the green number that they got. They sell and they bring in the huge premium. And that's what Buffett did. That's what Buffett does right there. Okay? So I'm going to sell one put contract, $18 strike price, premium's $1.25, expires on 11/6, and I just got $125 for the premium. It's for the premium. Okay, now 3 things are going to happen. Number 1 is UVXY is going to stay the same. Actually, we'll do it higher. No, it'll stay the same. And on 11.6, it's not lower. It's got to go below 18 and $1.25. 18 minus 125. That's a cost basis of $16.75. So if it's the same price as it is now, $18.20, as long as it's above 18, you keep 125 bucks. You don't own any UVXY, but you just made $125. And then on 11.6, you could do it again. Second scenario, UVXY on 11.6 is higher than 18.20, where you just saw it and you did that. As long as it's higher than 18, you win $125 for doing nothing. For doing nothing. You won there and you won there. Scenario number 3. UVXY is below 18. You now own 100 shares. Hey, 100 shares at 18 on 11.6 is a hell of a lot better than 100 shares at 18.20 where it is right now, right? That's what Buffett says. And for doing that, you get $1.25, $125. So that reduces your cost basis from 18 to $16.75. So UVXY can go all the way from 18 to all the way to $16.75 and you won't lose. That's a pretty damn good bet, man. On a risk-reward ratio, that's like a 1 risk to a 10 reward. And if UVXY is $16.75 on 11.6, wonderful, I own it. 100 shares. I'll do it again. I'll sell the $17. I'll bring in another $1.25. My cost basis will go from $16.75 to $15.25. I'll do it again. It'll go from $15.25 to $14. Mid next year, I should be at about $12.50. By the end of next year, I should have a cost basis of around $9. Still on my 100 shares. Gotta believe them. I'm gonna be right at some time. I'll just keep on selling it, man. That's it. Okay? That's called a put. So you got from 18.20 to 16.75, no worries. This is break even. And that's a lot better than buying it at 18.20. That's what Warren Buffett does. He's got no worries. He wants it to come down. He wants it to own it at 16.75. It's at 18.20. Says, yes, today I'll take it at 16.75 because it's worth 17.50. He wants to do it. Absolutely. So the first thing that you do is you sell a put and you bring in that premium. You may be obligated for the 100 shares. The second thing you do is you buy 100 shares at 18 bucks. It's at 18 right now. Okay? You're buying at 18. 100 shares. Let's go back to the options. Now we're going to sell a call for the same thing. Let's see, November 6th. It was November 29th. So November 29th, No, it was November 22nd. You'd have to wait till November 22nd that day is. No big deal, anyway. So the call, you'd go to the 19. And the $19 call is $1.17. So you're buying 100 shares at 18. You're going to sell one contract representing your 100 shares. Selling one contract at $1.20. Let's do it for math purposes rather than $1.17 because it was down 63. I'm sure you can get $1.20. Okay, so you're buying 100 shares at 18, selling one contract of the covered call of the $19 strike price for $1.20. Okay, three things are going to happen. Number one, it's going to stay the same. If it stays the same, you collect the $1.20. It did nothing. It's not going to get called away. It's got to go above 19. So if anywhere from 18 to 19, you're good to go. So you collected a $1.20 premium there, plus the other premium of $1.25. You've made $2.45 in premiums. Amazing. So you're going to sell the put. You're going to buy the shares. Then you're going to sell the covered call. If the stock is the same, you win on the put, you win on the covered call, and you still own 100 shares. If the stock is higher, let's say it's 20, you're going to win on the put, $1.25. You're going to win on the shares, $1, because it's going to get called away from 18 to 19. And you're going to win $1.20 on the call option. So you're going to win $3.45. And you're going to own no shares. But you made $3.45 on an $18 stock in a month. So 3.45 divided by 18 is a 19.1% return in a month by November right here, this call. It's just, dudes, it's unbelievable. Okay? If it goes lower, let's say it goes lower to, where is it, 18? Let's go say it goes to 17. No problem. You own 100 shares at 18 where you bought it. You keep the $1.20 premium there, plus the $1.25 premium there, and you own 100 shares. So your cost basis is reduced by $2.45 on an $18 stock. Cost basis of $15.55. It's called the triple threat strategy. That's what they should be doing. Because if it goes down, it's a stock that you want to own anyway. And then you own it, and then you just repeat the covered call strategy on it. It's a great, great, great strategy, man. It's called the triple threat. You can collect two beautiful premiums, the put premium and the call premium, and still own the shares. If it's the same or goes lower. If it goes higher, it gets called away from you. You don't own the shares, and you collect both premiums. You're a premium collecting machine, just like Warren Buffett. That's all he does. That's my UVXY protection right there. Shall Allah UV go up? Look at the year to date on UV right here. UVXY. Year to date. Thing used to be in the 50s. A full screen. Look at this. Year to date. Stock right up here was 83. On January 3rd of 2019, it was 83. Oh, this is funny. That's what I see Ross do. He takes the top of this. Instead of connecting the top where it should go and creating the channel from the bottom. He went like this. He went like this. connected it through the bottom. And he's a teacher. That's unbelievable. Dude, if you're gonna draw a chart, you gotta at least know how to draw it right, man. So you go here, the top point here to the top point there. And the bottom is actually here, because this is higher over here. Actually like this, right to the back. So you're looking at a very nice little buy zone in here, man. You see how wide it is here? Really wide. Down to this bottom. So you're in a little tight little channel right here for a beautiful move up. I'm telling you, you got a little what we call a dragster trade play right here. You got the engine block right there, just ready to take off right there. The Roadster. Absolutely. So that's the UV right there. Let me show you some of the, that's Buffett's approach. Afraid of you.